Hello and welcome to the Nonprofit Investment Hub YouTube channel. Just before we jump into today's video, I wanted to let you know that our webinars typically are very content heavy. And so we've included timestamp chapters that you can click on to navigate to a particular section if need be. They'll also be included in the description. Also, if we happen to have published a video in the future that covers this same topic with more up-to-date information, we'll be sure to pop a link to that in the description below. Finally, please subscribe to our YouTube channel, like this video if you find it useful, and explore our library of content. You can visit our website to learn more about how we partner with nonprofits or connect with us on LinkedIn. You can find us there under the Nonprofit Investment Hub page, or you can connect with me directly, Chris Carey, also. And with that, let's get started.
Hello, everyone. We are so excited to have you. Please let us know where you're calling in from. It's one of my favorite things. Hey, Chris, we just heard you. It's one of my favorite things to see where all the organizations, what organization you're working for, and where you're calling from. So myself, with my colleagues Mindy and Chris, who you'll meet soon, we are all calling from the Cleveland, Ohio area. We're at our Pepper Pike office right now. And the weather is cool, but not as cold as it has been, and it's not snowing, so we are not complaining around here. So I am interested, as you guys are putting in where you're from, what organization you're from, I am interested. How confident do you feel communicating tax-related updates to your donors? So put in the chat on a scale of 1 to 5, 1 being I have no idea and I avoid it like the plague, all the way up to number 5, saying I'm super confident, bring it on. I'm sure we have people all over the board, but we would like to just get an idea of where everybody's at so we can make sure that this information is, tailored to where you guys are. So I see lots of people in the chat. Oh, I love it. Oh, we've got, Magnolia Clubhouse right in Cleveland. I love it. All right. So people, we do have a couple 4s. So Erica and Don, I'm proud. I'm very proud of you. Great. You feel a little bit confident. We will still be giving you some updates today that you can share. And then as well as, whoopsies. Had to take a second to admit a few more people. Thanks for taking that second. But I see a lot of people in this chat are 1s, 2s, 3s. And so we're going to make sure that you leave, feeling more confident today. So our goal for today, pretty simple. We want you to be able to understand the new tax changes, know exactly which donors each of them matter for, and then give you some clear and simple language that you can use as talking points in your year-end conversations, as well as future campaigns, because some of these changes are not taking effect until 2026.
Indeed. And just in terms of who we are, I promise these are going to be the only 2 slides that we're going to plug who we are and what we do. So we are the nonprofit team here at Carnegie Investment Counsel. We're a registered investment advisor, and we serve clients all across the United States. We manage over $7 billion in assets for individuals, nonprofits, and institutions. But in my mind, what makes us the best is that we're the only IRA in the only RIA in the United States that goes beyond investment management. And we provide our clients with complementary development services. We help organizations strengthen their fundraising and stewardship strategies through education, resources, and tools like this webinar. So who are we? First up, we have Megan Lenkowski, Carnegie's wonderful nonprofit development specialist. Megan has spent the last 12 years in the nonprofit world, primarily fundraising and development, helping organizations grow their revenue and make a bigger impact. And I'm Chris Carey, Vice President and Portfolio Manager here at Carnegie. I work with our clients to provide them with strategic financial guidance and help them steward their funds through effective management and governance to ultimately help them achieve their goals. And it's great to see so many clients, just individuals from the nonprofit world, a handful of other advisors as well. And so we're excited to get into the content today. But just a quick disclaimer before we do. The information presented in this presentation is for general informational purposes only and is not intended to be construed as tax or legal advice. And we recommend consulting a qualified tax or legal advisor to address your organization's or donor's specific situations. Okay. So, with those formalities out of the way, let's look at what we're going to cover. And what I'd say is that there are three main segments. We actually gave this a fair bit of thought as to how can we break this out and have it actually be useful, especially if you're watching this back on YouTube. Hello to all the viewers in the future. So, here's how we're going to tackle it. First, we are going to cover what is changing for small to mid-sized donors. These are your everyday donors. Second, we're going to cover what is going to change for larger donors, those who itemize their taxes. And then the third is kind of a catch-all category. There's some additional changes for corporate giving, plus just some additional information that we think is going to be very useful to keep in mind. And for each of these three, we will cover both what is changing, how you can effectively communicate it, and how this change is potentially might change giving patterns. And I can promise you now, we are not going to be walking line through line going through a tax return. Not only do we not want to put you all to sleep in the middle of the day, but we're also not CPAs. We're focused on actionable information for nonprofits. You're busy enough as is, and we want to give you just a few takeaways that can help you be better prepared for these challenges so that you can effectively communicate where necessary with your donors. And throughout this entire thing, if you have questions, please pop them in the chat. We have a dedicated Q&A section at the end. That's where we'll answer those. If we can't get to any of those questions during this time, if we run out of time, I promise you, we will reach out to you and make sure that we give you the information that we need or connect you with someone who can. So, without further ado, what's changing for those that take the standard deduction, the everyday donors? Well, there's a new above-the-line charitable deduction in 2026. In terms of what's actually changed, this is actually a revival of a pandemic era incentive for tax year 2020 and 2021 that was it's now been made permanent and it's actually been increased to a more meaningful level. And this is what we call an above the line charitable deduction. What this actually means, though, is that on average, 90% of donors who take the standard deduction on their taxes are now eligible to effectively reduce their taxable income by up to either $1,000 for single filers or $2,000 for those who file jointly. Again, 90% on average of people file their taxes this way, which means that this opens a huge door for those people who get a tax benefit for supporting your cause starting in 2026. And we're not talking about major donors here, obviously. We're talking about the $25, $50, $100 donors, the monthly givers, the supporters who give because they care, not necessarily because of tax strategy. And for years, they've donated to you because of the great work that you do. But now there is an additional incentive for those who don't necessarily proactively plan ahead for taxes. So who can benefit from this? Essentially, everyone. There are some exclusions, and those are private foundations and donor-advised funds. And this also just applies to cash gifts only. And since I've seen this question before, no, cryptocurrency is not classified as cash. So what are the changes you might see? Well, during the pandemic, when we had that sort of small incentive, we saw that around 30% of filers who took the standard deduction decided to take advantage of it. And hopefully, given that this isn't a temporary version of this perk any longer, we'll see a more meaningful pickup in the amount of people, and hopefully with better promotion as well, more will take advantage of it. Furthermore, some tax planners are recommending that some who do take the standard deduction and know that they will in the years going forward, actually write checks to charities in 2026 instead of rushing to give at year end of 2025 this year. And just to put some numbers into context, as an example, a married joint filer who normally donates $1,000 each December might instead to choose to wait until the beginning of January to give that $1,000 and then make their usual $1,000 gift in December of 2026, because doing so allows them to claim the full $2,000 above the line deduction on their federal tax return for 2026. And if they given that they won't itemize. And that can result in a $440 tax saving for someone who happens to be in the 22% tax bracket. So it's real money. And I've seen some arguably dramatic headlines that say that January is going to be the new December. And I don't think so. But besides, even if it does mean that some donors do decide to wait a few more days until donating, this is only a one-time pull forward, as this is becoming a permanent addition to the tax law. And that starts the 1st of January 2026. And what this means is that it's important to start educating throughout the year, not just at year end next year. You want this on people's radars before they start making decisions, especially if your organization relies on volume from small to mid-level givers. And to talk about that much better than I can, Megan, how do we identify with these donors and communicate with them effectively? Over to you.
Yeah, let's talk about it. And real quick, before I get into that, just so I can make sure that we're all on the same page, Chris, can you make sure that this is correct? Is that for 90% of tax filers, they take the standard deduction. And
Yeah,
so now for all of those people, before they were not receiving a dollar for dollar tax write-off for their charitable deduction, for their charitable giving, because they were taking the standard deduction. This
yeah,
is now saying that you can still take the standard deduction, and then you're on top of that, you get a potential $2,000 in write-offs for charitable giving, something that was only given, in small portions or not at all in the past.
yeah, exactly. Pretty much nailed it on the head.
Great. So, all right. So, for this change in particular, you are looking for your everyday donors who do not normally give at high enough levels to itemize. So, what does this look like? You can look for donors who give normally between $5,000 and $2,000 annually. You can look at households that make small recurring gifts. Maybe it's a $10 to $50 monthly gift. Or look for donors who are involved in a lot of different ways. They come to your events, they volunteer, maybe they're advocates for your mission. These are the people who have always supported your mission and your cause and have showed up for you, but now there's actually a slight incentive for them to continue to show up. And so your job is going to be to educate these donors throughout 2026. As a reminder, this is going to be starting January 1, 2026. So this will be starting for next year's campaigns. For your goal to be to educate this donor segment here about these changes. Now, I'm not expecting you to leave here with a very rigid segmentation of these exact donors are going to be whose benefits. But what I want you to get is an idea of the types of donors that this change is affecting so that you can identify throughout your campaigns in 2026 areas where you can educate donors about these changes that could benefit them. So, how do we communicate this then throughout the year? So, I would encourage you to weave this into your communications plans for 2026. You don't have to do an entire new campaign. We really just want to drop in quick reminders throughout the year so that donors, as they're making their giving decisions, they're aware of this opportunity. This may mean that a donor that normally gives you $1,000 will give you $2,000 because they are married, filing jointly, and they would like to take advantage of that tax deduction. So, what are going to be some ways that we can incorporate this into your current campaigns for 2026? You could mention it in your annual appeal letter. That could be adding a PS at the bottom. We know that those PSs get read at a high rate. We like to skim. We read the first sentence, some bolding, and then that PS statement is very strongly read. So in adding a PS or a few sentences into your appeal letter, you don't have to change the structure of the appeal letter itself. You're going to be doing what you normally do, but you can add something like, hey, PS, new in 2026, standard deduction filers can now deduct up to $2,000 in charitable gifts. Or something like PS, if you take the standard deduction, a new charitable tax benefit begins in 2026. These are all ways that you're not trying to explain it all in one sentence. You're just trying to give them the idea so that they can say, oh, hey, I take the standard deduction. Maybe this could benefit me. And then they can do their own research on their own. Another way is adding something it, or I'm sorry, having an entire did you know email. So at some point throughout the year, having one email that is sent out to your segmented list, whatever that looks like, that is an easy touch point that is going to hopefully be providing value for your donors. You're not even really necessarily asking for a solicitation or a donation in this email, but what you want to know, what you want to make sure is that your donors are educated on this change. So something like, did you know that starting next year, this year, whenever you send this, households who take the standard deduction can claim up to $2,000 above the line charitable deduction? Again, putting some short language in there and then encouraging them to talk with their tax advisor or financial advisor to see what is going to fit their situation and benefit them the most. Another way is adding a specific call out or box to your ways to give or donate page. You could do this all year long. You could also do it during specific campaigns. So maybe you have a spring annual campaign, next year during your year-end giving campaign, Giving Tuesday. You can pick these specific campaigns to call out this change and create content around it. And the people that are on your ways to give page, on your donate page, these people are high intent visitors. They likely are in decision-making mode, and even a small education or hint of a tax benefit could create an idea to donate more. And so putting the information where your donors are strategically is throughout next year is going to be important. And adding small call-out boxes, pop-up boxes, some CRMs and websites even allow you to target by person. So by visitor, you can target donors who have visited your site before. So you know that there's an extra high intent, and then show them the pop-up box. So again, we just want to make sure that we're educating the donors where they're at so that they can make the most informed decision for them. And then the last place is going to be social posts. This can be super casual. Again, we're sprinkling throughout the year, adding a post with a graphic or a reel with graphic or with text overlaid. Saying something like, most of our supporters take the standard deduction, and starting in 2026, you finally get a little tax benefit for giving. Again, we're planting the seeds so that they can then reach out and find what works best for them. All right, so we've gone over what is changing for these mid-level donors. Chris, let's move into a more major giving changes. What's changed? What will be changing?
Sure thing, Megan. So, right off the bat, our first category was a lot more straightforward than this next section. But again, it's so important. I am gonna make sure that I quickly outline what's changing. I'll give you an example of what that looks like on paper, and then ultimately what that might mean for you. And I promise I'm not going to get too technical. So let's first start off with SALT. So SALT stands for state and local taxes. So given the standard deduction is just over 30 grand for joint filers, starting this year, so 2025 through at least 2029, the amount of property, state, and local taxes that filers pay that they can then deduct against their federal income tax return has gone up from $10,000 to $40,000. So what on earth does that mean? That means that a lot of people who are paying a significant amount in those for property taxes, state taxes, and local taxes might actually benefit from itemizing. And what that means, and also important to note, is that there is a cap to this phase out. So if you have income that's above $500,000 and uh, there's a phase out between 500,000 and 600K where it goes back down to the original 10, but there's still a huge swath of earners that are going to be itemizing um, potentially for the next few years. They think that I've seen estimates that say that those who itemize would take up from around 10% to maybe 14 or 15. So it's not a sea change, but it's still something. Um, we're also going to see in beginning in 2026, and this one is permanent, is that itemizers are going to be subject to a new floor for deductions. Basically, that means that the first 0.5% of your income that you donate is now no longer deductible. And also, for those that are fortunate enough to be at the very, very top rate of tax, that top rate has been capped from 35, from 37 to 35% in terms of what you can deduct. Um, but we also saw that the limit of how much cash you can deduct against your overall income in a given year is now permanently fixed to 60%. So there is some good news. It was set to revert back to 50% at the beginning of next year when you donate to public charities. So I mean, that's good. So what does this actually look like on paper? Just to show you what that new floor looks like for someone in 2026, say they're fortunate enough to have $1 million worth of income and they donate 5% or $50,000. The first 5,000 of that, which is 0.5% of a million, is not going to be tax deductible. Again, that's just the amount that isn't going to be deductible. So the tax that's charged on that 5K is only going to be a fraction of that. And the same math applies on the other end of the scale. Those who are pushing against that new 35% cap, which is down from 37. So their overall deductibility is going to be a little bit lower, but it's not going to be a huge change from what they're used to. But more importantly, how can this impact you? I think that we will see an increase in what are called bunched gifts starting this year. So, for those that want to take advantage of that salt cap rising, they might be encouraged by their tax professionals to essentially front load, say, 2 or 3 years worth of giving into one in order to bolster the amount that they can itemize. The same premise applies to those that want to get ahead of the floor and cap deductions that I just mentioned as well. We might start seeing an increase in prepaying pledged gifts. Some might want to accelerate those. And that means that on your end, you might receive a spike in donations, but importantly, you might not see those in future years. So if you do see these spikes, if you're used to sort of seeing a regular amount of donations from a particular donor, if that activity changes, when you're following up and thanking them, it is worth asking if they are bunching for tax reasons or if they just happen to be increasing their generosity. We're going to hope, obviously, that it's the latter. But if it is the former, it's important to loop in your CFO or treasurer to make sure that you're budgeting appropriately year over year. Or, all this said, you might not see a difference at all. Donors might choose to do this bunching within a donor advised fund and then just continue their regular giving year on year to your organization. And on the note of deaths, I did want to mention, please make sure that your organization is registered with the major DAF companies like Fidelity Charitable to receive funds electronically. It's so much faster than receiving checks, especially at the end of the year. Things get super busy. Much better for you to receive your money in 2 days than in 2 weeks. So have a perusal of those websites to learn more about that. And if anyone wants to learn more, just connect with me after this. So these are a group of donors that are likely to be a lot more tax aware and focused on giving in a much more efficient manner. And so the big question comes, knowing that these changes are in play, what should we be doing over the next month and a half? Because that's essentially our deadline. And so, Megan, what should they be doing?
All right, so let's start with identifying where you can find these donors that are probably going to benefit from these specific changes. These are going to be your major donors. Again, as Chris said, these are people who already itemize and who give larger, more structured gifts. And so I pulled out a couple key things to look for in your as you're reviewing your past donor history. One is annual giving of over $3,000. That's going to signal that they may itemize throughout their year on their taxes. Also, look for people who make large Q4 gifts. These are people who have capacity to give, and also are probably making those last gifts, especially coming in November and December, in response to tax planning, in response to either themselves being proactive or working with their financial or tax advisor. And so these people are going to have this on their mind anyways, and so they're going to be someone that can benefit from this type of change. You can also think of your donors that have given pledges or structured giving around taxes, or donors who have asked questions about taxes, especially major donors. These are the people who are really going to benefit from this change. Now, as Chris said, if we're looking at the next, is it 6 weeks until the end of the year? Oh my goodness. When in that time, we are not going out and developing full new relationships with major donors. That's something to happen in 2026 and beyond, to continue to nurture, gather new donors, nurture them, and move them into your major giving. For right now, looking at these last several weeks in the year, we really want you to be able to have conversations with people who are already in your sphere, who already love you, and who may just benefit from these changes. So I recommend that, first you look at your list of major donors and flag the ones who routinely ask smart questions, give appreciated assets, time their gifts around year end, fall into any of the categories that we just talked about on the last slide. Make a list and then prioritize. So not everyone gets the same attention from you. You don't have time for that. But what you do have time, and what I encourage you to make time for, are key conversations with your major donors. That probably is part of your year-end campaign as it is, but this is just one more touch point that you can have with these donors to really provide them value. Then once you prioritize and have your list that you feel that you and your team can conquer, you're going to personalize and engage. So this is a quick phone call, a voice memo, a personalized email, something that introduces these changes. Really, you're not soliciting, you're providing a service for them. You're providing education for them. Let them know that you were thinking of them, and then always remember to appreciate their past support. After that, then you're going to invite that strategic giving opportunity. So when the conversation is right, when you feel comfortable enough with that donor, then that's when you're going to make that ask and partner it with that you as the donor may be able to benefit from these tax changes as well. So how do you have that conversation? You had a phone call, you had a quick phone call, you scheduled your coffee date, you're going to meet this major donor. That's great. You're going to start with impact. So we're always going to bring that relationship back to what they have done in the past. You don't have to bring up the tax law right away. You're just going to remind them of the impact that support will have on your organization. Then you're going to introduce these tax changes briefly. So again, you're not providing tax advice here. Your job is to introduce these changes and then to encourage them to talk with their advisors. So, did you know that there's actually a couple of year-end tax changes that could benefit people who itemize, especially people like you who XYZ input why they came to mind that you think that they could benefit from this. Then again, you're going to encourage them to consult with their tax advisor or financial advisor. Feel free to make it joke, a little lighthearted. I am no tax expert, but I do care about you, and I want you to be able to benefit from the support that you give us just as much as we benefit from the support that you give us. So, you can stay out of the weeds. You're just really trying to position yourself as a trusted resource for them. And then you're going to end with reconnecting it back to your mission. So always bring it back to your mission and what the support would do directly, how it would directly impact your your organization. Something like, this support could make a big impact on our youth program this year. Um, if it ends up making sense for you, it could have a big impact on our scholarship fund this year. Remember to bringing it back to the impact, tug at those heartstrings, and then provide them the tools that they need to give in the best way possible. All right, so we've reviewed what's changing for our mid-level donors, what's changing for our major donors. There are a couple other areas that we wanted to talk about and bring to your attention. Chris, let's start with the corporations. A lot of people have corporate partners, corporate sponsors that they work with throughout the year. What's changing for them?
Yeah, sure thing. So, for corporations, there's a new 1% rule, and that means that they need to give at least 1% of their taxable income before gifts qualify to allow them to deduct that from their taxes. There used to be no minimum. So now there is. And what that means practically is that companies that are giving below that 1% floor are going to have to make a choice. They may scale back, or they may consolidate their giving into fewer, more focused partnerships. And they might choose then to focus on where they can make a larger impact and maybe even try and hit that 1% threshold more easily. Or they may increase their giving to organizations they already support rather than spreading small grifts across many nonprofits. And either way, this creates an opportunity for nonprofits if you already have a relationship with them. So here's what you can do on your side. I mean, first, it's to strengthen the corporate relationships that you already have. Show them the impact of their past giving. Remind them why your mission matters and keep the relationship warm all year, not just in December. And also focus on demonstrating outcomes and engagement. Corporations will be more selective, most likely. So it's important to be ready with clear results, clean reports, and examples of how their support drives measurable community impact. And if you can, encourage deeper involvement. Invite employees to volunteer, participate in events, co-brand some initiatives. When staff feel more connected, companies are more likely to keep you within their giving portfolio. And the big takeaway here really is this rule doesn't create a rush for new partnerships, but I think it's just an important reminder to try and focus on increasing the value of the partnerships that you already have. You want to be one of the organizations a company thinks of if they are considering consolidating. You don't want them to consolidate away from you. You want them to consolidate towards you. And on the note, we're just kind of like clearing up the periphery here. Just a couple of other things that not necessarily changing with the new tax law, one of them is, but just stuff I want to make sure people are aware of. The first one is I want to highlight again QCDs, which are qualified charitable distributions. They are still such a super useful tool for donors that are aged 70 and a half or older. Regardless of how they do their taxes, it's a great way for those who would otherwise be forced to take a taxable distribution to send those funds directly to a nonprofit instead. And the distribution to the charity never gets counted as income. So that means that they can donate more than they could have via the new above the line deduction. And if they happen to itemize, this QCD isn't even subject to that floor or cap that we discussed earlier. And I want to also stress that whilst you may think that donors are aware that they can do QCDs, a lot of them aren't. And if you don't tell the world that you accept them, if you don't list an address for them for checks to be mailed to you from their custodians, you may be missing out. And I've happened to peruse many of the organization's websites who are here today. Some do an exemplary job, some don't mention them, and some, I think, explaining the benefits, putting the address in, why should they do this? Very, very useful to do. Secondly, I wanted to highlight stock donations. So we have a whole webinar on this, and we'll send that along with the resources. It's also on our YouTube channel. But with a month and a half to go, I want to stress that this is a fantastic tool for organizations to have in place to allow donors to give in a tax-efficient manner. Make sure that you have the infrastructure in place as well as the appropriate governance documentation on your side to accept them. And if you have further questions, you know where to find me. And then finally, I did mention that there was one new thing coming up, but it's not this year. It's actually it's starting in 2027. The OB3 also added a new tax credit, not a deduction, a credit for up to $1,700 per filer for gifts to charitable organizations that are structured as scholarship granting organizations, but solely for elementary and secondary education, which translated means K through 12. The credit is also non-refundable, so it may not reduce your tax. So it may reduce your tax liability, but not below zero. And as I mentioned, it only applies to contributions received beginning in 2027. So given the popularity of this webinar, we'll probably do another tax-focused one this time next year, and we'll have more information on it then. Okay, right. So it is 1:36 on the East Coast, and we have covered quite a lot today. And I'm sure there are questions. I've tried to tackle a couple in the chat when I haven't been speaking. So before we get to those, I just wanted to mention that this concludes our 2025 webinar series. And we've loved having you join us and chatting with you each month, and we'll be back in 2026. We'd love for you to be able to connect with us on LinkedIn. URL should be there. Just search our names. Our photos match. You'll be able to find us easily. And also subscribe to our email list. That's a great way for you to be able to stay connected. And with that, let's go ahead and answer some of those questions, if there are any. I'm going to take a look in the chat after speaking for the last 5 or so minutes. And so let's dive in. Megan.
Yes, yeah. Chris, go ahead and take a breather. We're going to dive into some questions. I do want to share one story, and I'm going to share it. It's from our colleague Mindy, who's also on the call, and I forgot to ask her about this, but I'm going to do it. I want to just highlight this story for the nonprofits that it would work for. Mindy, this is a few years ago, received an email like the day before taxes were due or 2 days before taxes were due. And although she is always on top of everything that year, she just happened to not be, she was finishing them up. And she got that email, and it was a very well-written email that described that there's an opportunity to donate to her children's private school, and that she would receive an immediate tax deduction or credit. I'm sorry, I forget exactly what the benefit was, but the reason that I bring the story up was because Mindy was not planning on making a 2,000. I think it was like $1,000 or $2,000 donation. I
Yeah,
see her come up.
$1,000 donation. And it was that if I made it in a certain way through a certain method, the money would go to the school instead of the state. And I'd
Thank you.
rather it go to the school instead of the state as I was wrapping up my details last
Yes.
minute.
Yeah, thank you for that
Mhm.
context. And so she was not planning on making that $1,000 donation, but once she saw how easy it was and that she could do that, she did. And so, because of that random email that she was not expecting, that I'm sure the school sent to everybody, that she was able to quickly make that adjustment. And so that was just one example I wanted to share for the power of sharing these unique tax advantages for your donors that they may not know about. Her kids have gone to that school for years, and she didn't necessarily know that before that day that she could do that. Okay, so
All right.
yes, we do have a few questions. Chris, do you have one that you'd like to answer?
Sure. I mean, honestly, I was just going to go through the ones that were in the chat first,
Let's do it.
some of which I replied to, but hey, we'll get it on record. And if you're watching this on YouTube, you can't read the chat. So let's try and benefit everyone here. So let's see. Is there Dawn always asks great questions, but she asks, is there a floor for the donations for non-itemizers in 2026? Short answer is no. If you give $100, you still qualify for this. You don't have to hit 2,000 on the nose, or 1,000 if you file jointly. Hey, will the slides be shared? Yes, they will. I promise you that. Okay, as we're discussing these, Dawn asks another great question, which is, as we are discussing these tax changes with donors, is there some context we can provide? Basically, to summarize this, like why are they doing this? The short version is that with the new with the tax laws that were made permanent back from 2017, 2018 time, when we had the Tax Cut and Jobs Act passed, that raised the standard deduction. And so what we saw was that like charitable donations from those pool of people that take the standard deduction kind of overall declined. And so this is a way that policymakers are able to now incentivize people to increase charitable giving. And that's kind of also why for those that itemize, there's that floor and that cap that I discussed. It's kind of a way to make it, I think I remember reading that, you know, it's going to be like a $30 billion loss to taxes by doing, in terms of tax money that comes to the federal government by allowing people to do this via the standard deduction. But also then they estimate they're going to recoup pretty much all of those losses by making the first 0.5% of deductions, in our first 0.5% of income not eligible for deductions. Wow, that's a fun sentence to say quite fast. Anyway, so it kind of came with something that was net neutral, but it was a great way to incentivize a lot of those small to mid-sized donors to contribute and make an impact locally. So pretty nice. Okay, now let's see. Were you going to say something?
Yeah, as you're pulling up, finding your next question, there is a great question from Ashley here. She's with a small animal shelter with a small donor base, and she says, would this be a good idea to do an educational campaign or solicitation to have donors pay $1,000 throughout the year so this would qualify for that deduction? I love that idea, Ashley, and I think you could even do something, especially if you are a small organization that doesn't have lots and lots of major donors that you can pull from. Monthly giving is a powerful, powerful way to get people involved. Just like all those subscriptions that we sign up for, get a box, you get your Netflix. All of those things are a low level of effort of money, and but that adds up over time. And so Ashley, something when I read your question, what came to my mind is if you did a campaign around trying to get donors who can donate $100 a month, that's going to add up to $1,200 throughout the year. And you can sort of coordinate that with your stories and your impact that you're adding in that, hey, if you, do you know about this change in 2020, starting in 2026? Now non-itemizers can take advantage of this $2,000 charitable deduction for married filed jointly. And so for a way for you to take advantage of and get that tax deduction is by signing up for our monthly giving program. And $100 provides 2 nights of shelter for survivors of domestic violence. That's what I used to work for. So it's always what I go back to. But bringing it back to what is that money going to do with your organization, and then also sprinkling in how it's going to benefit that donor. I really love that campaign idea.
And actually, since Ashley, you're here, Ashley, you're the one I want to thank about making sure that I mentioned to remind people to make sure that they're set up when it comes to DAFs. I saw your LinkedIn post, and I just couldn't believe it. So crazy. So thank you for sharing that, and now I get to use this platform to share it with others as well. So Curtis asked a great question. Are there any legislative efforts to make 401ks and 403bs eligible to use QCDs for giving? I haven't seen any, and I don't think we'll ever get it. If you're 70 and a half, you're likely not to be working. A lot of 403b plans and 401k plans will allow you to do what's called an in-service rollover, which means you'll move it from the employer plan to an IRA, an individual retirement account. And people want to do that anyways because the costs associated with those are far higher than just opening up an IRA by yourself. And so I don't think they would want to incentivize people to keep funds there. So, my advice is if you have old 401ks lying around, you should be consolidating them anyway, because you're probably paying through the nose and not even realizing. So wish it was the case. Just to widen the funnel, allow more people to donate from those more tax efficient vehicles, but sadly not. Okay. I don't see any more questions at the moment. Please pop in the chat if you found this webinar useful. We're always keen for feedback. I think that this is a very sort of, this topic can become pretty boring pretty quickly, especially
And
if we get,
complicated.
oh my Lord, yes, so complicated. And so we want to make sure that, when we host these webinars, you're taking time out of your day. We want to make sure that it is valuable and it is useful to you. And if you do have any feedback, let us know, email us. We're not going to stop doing these webinars, and we want you to continue to join them and continue to, make an impact in our communities through them.
We appreciate everyone so much, and we will wrap up with a few minutes left. Maybe Chris and I will stay on for an extra minute or so since we have some time. If anyone would like to stay on and chat, we're happy to, but this is the end of the webinar. And so thank you everyone so much for coming.
Bye-bye. Thank you.